Owning a home is more than just having a place to live. It's also a significant financial investment. As you pay down your mortgage and your home's value increases, you build equity. This equity is an asset that you can access when you need it. One way to access this asset is through a home equity line of credit, or HELOC. Think of a HELOC as a revolving credit line similar to a credit card, but it's secured by your home. A HELOC allows you to access your home equity as a line of credit. Instead of borrowing a lump sum, you're approved for a credit limit to use as needed during the draw period. You can withdraw funds up to your limit and pay interest only on what you use. This flexibility suits various needs, from home renovations to debt consolidation. After the draw period, you enter the repayment period, making regular payments on the principal and interest. Understanding HELOCs helps in making informed financial decisions. Next, we'll compare HELOCs to other loan options. HELOCs offer unique features that set them apart from other loans. Let's compare them to common alternatives. HELOCs versus home equity loans. A home equity loan provides a lump sum with a fixed interest rate. In contrast, a HELOC offers a revolving credit line with a variable interest rate. HELOCs versus credit cards. HELOCs typically have lower interest rates but put your home at risk. Credit cards have higher rates but don't risk your home. HELOCs versus personal loans. Personal loans are unsecured with fixed rates but higher interest. Personal loans don't risk your home if you default. Choose based on your circumstances, goals, and risk tolerance. HELOCs can be valuable, but compare them to other options to make an informed decision. Section 4. Decoding HELOC rates. Factors that matter. Understanding how HELOC interest rates are determined is crucial for securing a favorable deal. Several factors influence the interest rate you'll be offered, including credit score. Your credit score is a significant factor in determining your HELOC interest rate. A higher credit score generally translates to lower interest rates. Loan-to-value ratio, LTV. LTV represents the amount you're borrowing against your home's value. A lower LTV often results in a more favorable interest rate. Market interest rates. HELOC interest rates are often tied to prime rates, which fluctuate based on market conditions. When prime rates rise, so do HELOC rates, and vice versa. Debt-to-income ratio, DTI. Your DTI reflects your monthly debt payments compared to your gross monthly income. A lower DTI suggests you can manage debt responsibly, potentially leading to a lower HELOC interest rate. By understanding these factors, you can take steps to improve your financial profile and potentially secure a lower interest rate on your HELOC. Maintaining a good credit score, reducing existing debt, and choosing a loan amount that keeps your LTV low can all work in your favor. Section 5. Navigating the HELOC application process. Applying for a HELOC requires careful preparation and documentation. Here's a step-by-step guide to help you navigate the process. 1. Check your eligibility. Before applying, review your credit score, debt-to-income ratio, and loan-to-value ratio to ensure you meet lender requirements. 2. Gather necessary documents. Be prepared to provide proof of income, employment history, asset information, and your current mortgage details. 3. Shop around for the best rates. Contact multiple lenders, including banks, credit unions, and online lenders, to compare rates and terms. 4. Complete the application. Once you've chosen a lender, complete a formal application. Be prepared to pay an application fee, which can vary by lender. 5. Appraisal and underwriting. The lender will likely require a home appraisal to determine your property's value. They'll also review your financial documentation to assess your creditworthiness. 6. Closing. If your application is approved, you'll sign closing documents outlining the terms of your HELOC, including the credit limit, interest rate, and repayment terms. By following these steps and being prepared throughout the process, you can increase your chances of securing a HELOC that meets your financial needs. Section 6. Advantages and disadvantages. HELOCs can be powerful financial tools, but it's essential to carefully weigh the advantages and disadvantages before tapping into your home equity. Advantages: flexibility. HELOCs offer revolving credit, allowing you to borrow funds as needed during the draw period. Potential for lower interest rates. HELOCs often have lower interest rates than credit cards or personal loans, especially if you have good credit and a low LTV. Tax advantages. In some cases, the interest paid on HELOCs used for home improvements may be tax deductible. Consult a tax professional for guidance. Disadvantages: variable interest rates. HELOC interest rates can fluctuate, potentially increasing your monthly payments and making budgeting challenging. Risk of foreclosure. Your home is used as collateral for a HELOC, putting it at risk if you default on payments. Temptation to overspend. The easy access to funds can lead to overspending and increased debt if not managed responsibly. Before deciding on a HELOC, carefully consider your financial situation, goals, and risk tolerance. Speak with a financial advisor to determine if a HELOC aligns with your overall financial plan. Section 7. HELOCs and Financial Responsibility Risks and Solutions. While HELOCs offer numerous benefits, it's crucial to understand and mitigate the risks involved. Responsible borrowing and proactive planning are essential to avoid potential pitfalls. Biggest risks: foreclosure. Defaulting on HELOC payments can lead to foreclosure, putting your home at risk. Debt accumulation. The revolving credit nature of HELOCs can lead to overspending and a cycle of debt if not managed carefully. Interest rate volatility. Variable interest rates can result in unpredictable monthly payments, making budgeting challenging. What to do if you can't make payments? Contact your lender immediately. Don't ignore the problem. Reach out to your lender as soon as you anticipate difficulty making payments to explore potential solutions. Explore loan modification options. Your lender might be willing to modify your loan terms, such as extending the repayment period or offering a temporary forbearance. Consider a home sale. If you're unable to meet your HELOC obligations, selling your home might be a viable option to avoid foreclosure. Remember, open communication with your lender is crucial if you encounter financial difficulties. By addressing the issue proactively and exploring available options, you can potentially mitigate risks and protect your financial well-being. Like and subscribe, and feel free to provide feedback and/or experiences in the comment section below. Have a great day. Article link is in the description box below.